And if we're below it, well, then we've got no business buying. Why not? It's just simple math. If you buy a stock and it goes down 50%, that stock needs to double for you to break even. If the stock drops 70%, you need to have a 233% return to get back to even. How many stocks have you held for a 233% return? Some of you, maybe you're going to raise your hand and say, my account is nothing but 200% winners. When the Dow Jones Industrial Average lost 90% between 1929 and 1933, it needed a 900% gain to make up for those losses. 900% gains aren't easy to come by. So to me, looking at the market, trading the market, it's just like the weather. We all look at the weather, and this is, in my mind, what technical analysis is about as well. Do you expect the weathermen to be perfect? No, you shouldn't, because their job is to give you an approximation. So when you look at the forecast and you're deciding which day to have your picnic, Saturday or Sunday, you're going to plan your picnic on Saturday because it's mostly sunny. Sunday, it's a 100% chance of rain. What people don't realize is that that means there's a 100% chance of rain somewhere within that forecast area. It doesn't mean at your house necessarily, but there's a 100% chance that if it's a zip code, or if it's a big city, that if I'm in Denver, if it's in Denver, somewhere in that city, there's a 100% chance it will rain on Sunday. So you want to plan your picnic on Saturday. Well, do you want to be a buyer when we're in a down market? No, you want to be a buyer when stocks are making higher highs and higher lows. This is your picnic time. This is when things are good. When it starts to turn sideways after a rally, then you look at it and say, okay, we've got indecision. But if it breaks down, you say, guess what? Pack up the tables. We saw the storm clouds on the horizon. Now it's raining. Let's get inside. Just like the market analysis and weather as well, you can't just look at the annual high and low for the year. I'm in Denver, like I said. So in April, the average low is about 45 degrees and the average high is about 65 degrees. But look at the variance between these days. We had, this was last year. We had lows as low as 25, 24 degrees and highs as high as, 80 degrees. So you can't look at this and say, okay, well, in the fall, I want to plan a family gathering or whatever. I think I'm going to do it between September and October, probably September 1st, because it's going to be 78 degrees. You can't look at that because that day in September, it might be 32 degrees and snowing. It's an average. And averages, that's what moving averages do. They tell us the weather. Where are we right now in the SPY? This is the 200-day moving average. We're below it, and it's making lower highs and lower lows. To me, it's guilty till proven innocent. To me, it's highly likely we'll continue lower. Doesn't mean it has to or it will. This chart is for today on the right. This is, yesterday we saw a huge rally in the market. This is a table I just saw this morning from Piper Jaffray, Piper Sandler, I think they call themselves now. But anyways, right here, this was yesterday's Dow Jones. This is for the Dow Jones. The Dow Jones had one of its largest one-day rallies ever yesterday, up 7.8%. We've had much bigger ones, but look at the average numbers of what occurred after these big days. The average after 1 week was a return of 1%. 2 weeks was 2%, 78 basis points. Then 3.9% 4 weeks out. A year, 26 weeks out, there was 3.6% loss and only a 9.7% gain for the following 52 weeks. This tells us statistics. It's back of the baseball card stuff. It doesn't mean that just because this player has an RBI of 264, he's going to hit the ball 26 out of the next 100 times. That's his average. The prior year, it might have been 292 or 118. They're averages, they're numbers. They just give us a benchmark to kind of say like, well, it's typically not very good. So what do we do with that information? Do we trade off of it? You can't trade off it and say, I'm going to buy today because in 52 weeks, I expect a return of 9.76% right down in here. That's foolish. So instead, we want to look at it and say, what's the worst it could happen? Down 65%. The best? 90%. Wow, that's the one I want to happen, so I'm going to buy today. Wrong. That's why we have medians as well. But the bottom line is we look at it and say, okay, the largest rallies typically occur in a downtrend, like it did yesterday in the S&P 500. It was up 10.5%. But when we look at this, so this is just the daily chart, a little bit magnified. This is the 200-day moving average. We're below that declining 200-day moving average. In my mind, it's a counter trend rally. The larger term trend is in a downtrend. Doesn't mean there aren't nice trades in there. I'm considering this market. It's even too volatile, I think, for swing trades. That's my preferred time frame. But it's more of a day trading environment. We also saw yesterday, it was the second biggest gain ever for the NASDAQ. So the NASDAQ had its biggest gain on January 3rd, 2001. The NASDAQ rallied 14.17% on that day. Incredible move. Well, look what happened to it for the rest of the year. Pretty incredible that this was the biggest day of the year, and then we saw, it ended right here. That was the end of 2021. But it did not come anywhere close to marking the low of the market. The low of the market occurred right there. This is where I think the buyers regained control, because at that point we had the market above a flat to rising 200-day moving average. Why is it? So right in here, that's when an investor should look at it and say, I want to be involved. Same like over here. This is where an investor wanted to be involved and probably be out when it made the lower low below those moving averages right here. This could be, I'm not saying it is, but this could be where we are in the overall market right now. We could be headed for one of these. I don't know. It's possible that we do a V bottom, but it doesn't seem likely to me. A trend once established is more likely to continue than it is to reverse. The four largest rallies occurred in the Dow Jones during the 1929 to 1933 period. In 1929, the Dow Jones Industrial Average lost 13%. Now, everyone remembers, the crash, the Friday, which I think was, I don't know if it was Friday. We don't remember it. I don't remember. I was still dead for another 40 years, 50 years. That's an inside joke, which I shouldn't repeat, I guess, because that's what my kids used to say. Say something and they'd be like, well, we were still dead, meaning we weren't born yet, basically. So anyways, that's them. What we see here, though, is that, during this decline, this orange moving average in here, which I'll just highlight a little bit, that is the 200-day moving average. And you can see that it was declining all the way till right here. It started turning sideways. And then we made a higher high above that 200-day moving average. That's when the bull market began. The bull market didn't begin on this day. That was still a bounce with a declining 200-day moving average. If you look at this period, again, this, in 1929, the market was down 13%. Not too bad. But from 1929 to 1932 low, it was down 90%. Again, you need a 900% return to make up for that. I always use simple moving averages. I can look at the chart and figure out what's being replaced with what. EMA, I don't know what the formula is. To me, simple moving average, and honestly, it probably doesn't matter. You're going to be in about the same place. And it's not a moving average system, by the way. Moving averages is simply a reference point to say, okay, it's below these moving averages, but look at these rallies. These rallies, while below the declining 200-day moving average, were 52%, 19%, 27%, 31%, 39%, 26%, 100%. Then this was your 102% rally right here. And that's when the market, that's when it bought, that was the higher, the low. And this is where you would have bought, let's just call it at 70. Still a big rally. But more important than these big rallies is the sum of the declines in a downtrend is always greater than the sum of the rallies. And guess what? News and surprises tend to follow the direction of the trend as well. So where is there more opportunity? Well, we had a 49% decline, a 30%, 37%. 39%, 45, 41, 54, 39%. These are huge moves that you can't get excited about these one-day gains. So again, the biggest gains ever for the Dow Jones were number one, March 15th, 1930. You had a one-day gain of 97 cents, which was 16.6%. That was close to the beginning of the bull market. The second biggest gain was right here, and the market rallied 12.5% that day. And we saw a nice little follow through, but right up to the declining 200-day simple moving average, and then it failed. The third biggest day was right here during this decline. It rallied, what is that, 12.3%. The fourth biggest rally ever was an 11% gain right in here on this day. So the bottom line is, when we have days like yesterday where it's up 10.5%, you can't get excited. The opportunities in a downtrend on those days are to say, here's something I don't like, I'm not comfortable holding XYZ stock anymore. I didn't realize it could go down that much. I'm getting a little bit of a reprieve. Time for me to lighten my position because on Monday, I felt like suicide. Thursday, Wednesday, when we had that 10% rally, I felt a bunch of bricks off my chest. And that is what you've got to try to avoid is the emotional decision making. If you couldn't stand it on Monday and you think like I do that this is just likely a bigger downtrend, then you need to lighten up. The biggest gains for the S&P 500 in recent, the fifth and sixth biggest gains ever occurred during the 2008 to 2009 decline. And what is this? That's a 200-day simple moving average. Don't trust rallies with a declining 200-day moving average because lower highs and lower lows is what you should expect. And here, the 200-day moving average flattens out and we see a higher high right here. This is higher highs and higher lows above a rising 200-day moving average. You're not going to get the bottom, but you know what? You're not going to get all excited and buy on this day and this day thinking that you have the low. You can't just look at it and say, oh, I would have bought there. Because if you claim that, you're probably also claiming, you're looking at it and saying, you probably, what I'm trying to say rather is, you would have tried to buy on this day right here, this day, this day, this day, this day. Wait until the buyers are in control for your time frame. So I'm using the 200-day moving average because it's topical right now. This is where the buyers regain control. That's where it made sense to buy. And then what? Well, then we look at it and say higher highs and higher lows. As long as it's above a rising 200-day moving average, we use the higher low and then get out right here and then avoid that chop. And again, so the question is, when do we buy? Do we buy based on the news? Do we buy based on what they're saying on television because Peter Navarro says so, or because Donald Trump says so, or in 1929, in September, U.S. Treasury Secretary Andrew Mellon said there's no reason for worry. The high tide of prosperity will continue. That was right here, right before the market pretty much got cut in half. Not quite, but pretty close to it. At the lows, Rockefeller came out and said he's buying sound common stocks. And everyone thought that was the bottom. But it rallied to where? The 200-day moving average, and then it started declining. And then Secretary of Labor said, the worst is over without a doubt. So people bought that, and we got a rally. But what happens to all these rallies? Same thing that happens generally. Yesterday, tweet at Trump at 9:37 said, now's a great time to buy. The market basically did nothing at that point for the next couple hours until he said, we're going to pause the tariffs. So we set an anchored VWAP from there. And as it loses that level, well, the sellers were in control right today, right until it came back down to the anchor from the low on Monday. And then we got a nice bounce in that. So these are, this is a 2-minute chart through 2:20 p.m. Eastern today. And no one goes to jail for market manipulation in these things. Just like Obama didn't go to jail when he said he thought it was a good idea to buy common stocks in 2009. And that one actually worked. The market went on to double after Obama said that. And I'm not calling any politician out. I'm just saying listen to the message of the market. Listen to price action, because only price pays. In 2022, we had a significant bear market. But look at these rallies. In each one of these rallies, there were people lighting up the boards on Twitter. There were analysts coming on CNBC or whatever your I got to turn this chat off. People are talking about war crimes and politicians. It's just useless. Anyway, so the sum of the declines is greater than the sum of the rallies in a downward environment. That's just a fact. So you have more opportunity to make money, and news and surprises tend to follow the direction of the trend until we run out of sellers, and then the market starts to turn sideways. And when the market turns sideways, then makes the higher high above that flat to rising 200-day moving average, that's when the bull market that just ended this year began. Right down here at 420, and here we are at 550 or so. I got 530, I think. But for investors, you could have made money buying in here, but and everyone gets excited about these rallies. But with a declining 200-day moving average, they're guilty until proven innocent. Higher highs and higher lows above that. So the same is true for an intermediate term time frame. Just replace the 200-day moving average with a 5-day moving average. How, for me, that's my intermediate term, swing trade. Some people like the 20-day moving average. Use the same logic. It doesn't have to be the 5-day moving average. It doesn't have to be the 200 simple. It could be the 200 exponential if you want. It could be the 250-day, 252, which is 1 year. It's up to you to decide. And here's the thing. I'm not going to pretend that V-bottoms don't occur, because V-bottoms do occur, but they are much less likely. This is, of course, the COVID one. So as a swing trader, I look at this and say, this is all good information about these 200-day moving averages, but these rallies, that's what I'm interested in going long during those periods. Just the same in here, I was getting long in here. I wasn't, expecting them to hold, but they did hold. I was expecting right in here that the market would probably find supply at the 200, come back down, and then maybe go. Instead, it went higher. So I don't sell short there. We want to anticipate. We look at these as levels of interest. I never look at a 200-day moving average and say the 200-day moving average is support. If you did that this time, you got crushed. And if you did it right here, you also got crushed. So the point is, there are levels of interest, because we look at it and say buyers typically show up at that rising 200-day moving average on the test, and they did. So we buy strength after the test. We don't buy the touch, we buy strength after. So quiz time. Who wants to solve this puzzle for me? Don't buy stocks in, you can figure it out, downtrends. So don't buy the dip. This is a daily chart. I'm sorry, this is a weekly chart of a stock in an uptrend. It actually happened to be Ford when Ford was moving. And you don't buy these pullbacks. These are big price movements. And if you bought that first pullback here, why wouldn't you have sold it here or here or here? Or did you average down all the way and then get lucky? Well, what about this time? Do you want to just average down lower and lower and lower and lower? Well, you didn't get lucky this time because the stock is significantly lower. So you don't buy the dip simply because the market is declining. You're not smarter than the market. And when it's declining, it's because institutions are selling hundreds of thousands and billions of shares versus your 500 shares, 1,000 shares, 5,000, 20,000 shares you're buying. The sum of the declines is greater than the sum of the rallies during these periods. So you don't buy the dip, and you don't buy the breakout either. You don't say, I'm going to wait for it to break out, because look at how much room, how much it traveled before you bought. You're buying late, and oftentimes those breakouts will fail. Instead, what do you want to do? You buy strength after the dip. And with a volume-weighted average price, what do we say? We take a VWAP and we say, okay, from the highest point paid right here, that's the average price. How do I get rid of that? So that's the average price paid since that point. Can I make this highlight? Where's a regular pen? Check mark, cross mark, dot. Maybe I'll just, is that a pen? No, that's a signature. I guess the highlight's the best I can do. So anyways, that works. So, we set an anchor there and say the average price on this pullback is losing money while we're below that VWAP. The average buyer during here Well, it's below the average price from the peak, they're losing money. But when the buyers regain control, not as it breaks out, but as the buyers gain control, they have 100% certainty. And this is all in wealth charts, the anchored VWAPs, that is, that you can look at and say, now the buyers are in control. So I'm on the winning team if I'm getting long. But you don't just automatically buy there. Of course, you have to look at, this is a weekly chart. You have to consult a shorter term time frame when you buy here and say, okay, where does my risk go? If my risk goes below the most recent relevant high or low, then that means it's below these blue arrows. And those are acceptable. So if you didn't get stopped out on this purchase, it makes a higher low, you raise your stop to there. If you raise your stop to here, you raise your stop to here, and then this purchase would be stopped out at this point. If you raise your stop under these higher lows, you might have gotten stopped out right there. And you know what? You weren't holding it over here at least. Cash is a position. When we're in an environment where the sellers are in control and you don't know what to do, what do? You wait and you buy strength after the dip. So solve this puzzle. What did I just say? Buy strength after the dip. This is too wide to do, so I can't solve it like that. But we want to buy strength after the dip. Don't buy the dip. And right now, the market is not dipping. The market is getting crushed. It's in a downtrend. Same thing is true on the opposite side. Do you want to sell short the rip? Do you want to sell short thinking, hey, I think it's up too much here, 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 and here, and here? No, you don't want to sell short the rip, because you might sell it short at, 35, and then 5 days later it's at 40. And you might be right about the overall direction of the trend, because let's say this is the 200-day moving average. You can't just sell short anywhere unless you really have no concept of risk management. Instead, do you short the weakness? Do you short the new low like you're told to? Sometimes that works, but where does your stop go? If your stop goes above the most recent relevant lower high, that means your stop is way up here. Your stop is way up here for this entry. For this blue entry, your stop is way up here. What's the better way? Short weakness after this strength. So what does that mean? Well, we take a look at it and we say we're going to put an anchor on that low. And we don't do it that day because we don't know that's the low. But maybe we do it on right here and say, okay, that was an important low because we bounced from there. Let's set a VWAP and we'll sell short as it makes sense, rolling over with our stop above the most recent high. Short here with a stop above there. Short here with a stop there. We've got momentum in our favor. We're not guessing. And we have a logical place to set our stop in case we're wrong. The sum of the downtrend is lower highs and lower lows. So we expect it to make lower lows. And if we enter here, we set our stop above that most recent relevant lower high. This could be a 2-minute chart if you're trading the S&P 500 future. This could be a 10-minute chart. It could be a 15-minute chart. It could be a monthly chart for Microsoft, which is rolling over, for JP Morgan, which JP Morgan, if we have time, maybe we can look at some charts, but JP Morgan looks like this over the last several years. Until what? Until we're right here, right now. Well, to me, that looks like we're about to do this. And then maybe it does this and continues higher, but that we're not there yet. I don't want this. I don't want to be involved during this big period of indecision. I want to buy strength, set my stop in a reasonable place, and if the market is truly in an uptrend, it's going to carry my stock higher with it. So simplicity truly is the market's greatest disguise. And this is an educational thing, and I've gone a lot quicker than I thought I would. So that's good in a way because we can look at some individual charts. We can take a lot of questions here. I'm happy to take any questions. So let me open that chat back up. But that QR code that you see here on your screen, I am doing a sale at Alpha Trends. So Alpha Trends is a swing trade service, and that swing trade service includes a end-of-day video every day at 4 p.m. Eastern, except today because I'm doing this. I get in front of the camera and I update all the ETFs, key points on shorter term and longer term timeframes, and possible plans of action. About an hour after that, I give another video with swing trade ideas in individual stocks. And then the next morning at 11 Eastern, I do another video where I update all those positions, update the market. So these are all, concise, they're educational. Everything I do is in a teaching way. I don't just say, hey, we want to buy at that VWAP. We want to buy a bounce from that VWAP because the buyers look like they're gaining control and would set our stop below here just in case. It's not buy here, sell there, or buying where they do buy, where they do sell. It's about education. I've also got a Discord channel where you can interact with me about individual stocks. I've got webinars 3 times a month, which are highly educational. And there are 2 educational courses of about 18 hours. And that's all included for $9.99. Together, if you bought them all together, they would be $2,320. So you save $1,320 if you use this QR code. That's good through I think through Sunday night. So let's take a look at some of these questions here right now. And let's see. When you have a chance to want to any specials for this conference? Yes, that's exactly what we're looking at. Let's see. Can you email our team? Oh, that's somebody else, I think, will do. How do you determine an extended breakout? That's a great question. And generally, it's just by eyeballing it, right? If we go back to, some of these, like here, breakout, look at how far it had to run to get to that breakout point. This one, not so far, right? Not so bad to buy that breakout. And the thing is, we had a consolidation here before that breakout. So in other words, here's where the buyers got back above VWAP. And in here, we had a nice tight range versus here, we ran, several days before the breakout. You can get a much better head start by buying here rather than after 4 or 5 bars and looking at it that way. So it's a matter of kind of eyeballing it. But I will also tell you that when we're in a bullish environment and people are asking me about stocks to buy, one of the most common things they ask me about, and I don't know why, this has just always been true, the most popular stocks that people want to buy are always the ones that are up about 10% in the last 3 to 5 days. If NVIDIA goes on a run like this, they'll say, hey, Brian, what do you think about NVIDIA? And they'll ask me right here. Say, momentum's in your favor, but it's extended. I wouldn't buy it here. It's too far extended. Doesn't mean you can't make money, but for some reason, people love stocks that are up 10% in the last few days. What I try to do is make the anticipatory purchase here. I want to sell a little generally when it breaks out. Because how often do you hear people say, oh, Brian, buying breakouts no longer works? Well, it does work if you're, if it works buying prior to the breakout and selling some into that. Any tips for day trading with VWAP? Yeah, I mean, one, look at Alpha Trends on X, on Twitter, but the daily VWAP on right here. You don't buy when we're below the VWAP. Look at Monday morning. This was Monday morning as it got back above the daily VWAP, and then later in the day, once volatility settles down, and in fact today, what this market did was it came down to the week-to-date volume weighted average price. So here we are on Thursday, and at about 10 a.m., 10:20 this morning, that's my time. So that's 12:20. 12:20. We pulled back right to that anchor from Monday morning, and then we bounced. That was the low of the day. So use those, many other days. So do I cover futures? It's not a futures trading service, U.S. equities basically, but I talk about the futures a lot, especially when there's an overnight range, a large overnight range. So, for instance, I've been trading, I trade equities, I don't trade the futures, but I'm aware of the levels on, the VWAP levels in particular on the futures charts because they have all that overnight range in volume that's occurring right now. So it's much more important to include all that overnight activity in your VWAP. So right now, I'm looking at the futures a lot more. Generally, though, I don't, unless there's a large overnight range. And that actually kind of answers a question that anyone was asking, and that's That is, how important is to look at 24-hour charts for equities. And I think right now it's not too important yet because the overnight volume is really low, maybe 5% at most of what it will trade during the day. So it's not enough to really respond to that, to that, short or have enough impact rather that we have to consider it. So someone's asked me, so you're not a fan of seasonality? Here's the way I view seasonality. And that's a good question because seasonality to me is a time of interest. It's a tool that says, 9 out of the last 12 times, Santa Claus rally in December, the 5 days after Christmas and before the new year, 70% of the time it's positive. Well, that's nice to know. So that's good. It tells me this is a time to be interested. But then when I look at the chart and I see we're below declining 5-day moving average, like we were in the so-called Santa Claus rally period of 2024, those first 3 days, we were down significantly. So I'm not going to buy just because seasonality says, it's generally positive. Generally doesn't mean all the time. In the market, nothing is all the time. Right. I had that on on that V bottom slide. There's no such thing as all the time. So it's about probabilities. So, just like the weather forecast, it's a time to be interested in, so here, nothing is always in the markets. It's, they're rare, but so seasonality, it's a time of interest. But if it's not backing up what I'm seeing on my chart, I'm not going to trade it. Just like a 200-day moving average is a level of interest. If we come down to the 200-day moving average, I'll look at it and say, here's where we're supposed to bounce. But I'm looking at a 10-minute chart and I see lower highs and lower lows. I'm not going to buy it. I want to wait to see evidence. So we look at seasonality. I look at seasonality as a time of interest. So I'm going to anticipate the possibility of potential strength. I'm going to be on higher alert, basically. DEFCON 3, whatever the DEFCONs are. And I'm going to say, okay, now I've got to be paying a little bit more attention than I might normally because the odds are this time of year is positive for stocks. But if the prices keep going down, I'm not going to buy because someone said it's typically going to do this or typically going to do that. So seasonality, time of interest, um, earnings reports are time of interest to say, hey, I've got to reduce my risk on overnight exposure or get moved to the sidelines if I'm not a fundamental investor in this stock. And technical tools, a daily VWAP, it's a level of interest. It's not an automatic place to buy or sell. It's a place to say, okay, let's look at the short-term time frame and see if we have evidence that the buyers are gaining control. If we have that evidence based on price action, not based on what somebody said, like when Trump said yesterday at 9:37 a.m., today's a good day to buy, the market didn't do anything for 3 hours until he went out there and gave the market a reason to buy. Why do you think the 50 versus the VWAP and how they behave since institutions buy above MA 500? I think that's a typo. I use simple moving averages and VWAPs. Moving averages kind of give me a reference to what's the overall trend, and then VWAPs give me a little bit better information on timing and saying, okay, from this point right here, the sellers are still in control. It might be the seasonal time. I might be looking at this prior anchor and saying, hey, that might become support. Okay, but it didn't. So it's a level of interest to me, that VWAP. If it continues to fall through there, I have no attachment to any technical tool. The only thing that pays is price. Only price pays. I actually trademark that phrase because that's what guides me is only price pays. I can have seasonality. I can have a 61.8% retracement. I can be on the 200-day moving average and the anchored VWAP from the last cycle low. And then I can have George Soros call me on the phone and say, I'm buying tomorrow. But if prices keep going lower, I'm not going to buy. I'm going to buy when I see buyers defended that 200-day moving average. Buyers defended that 61.8% retracement. Buyers defended that 200-day moving average or anchor from the prior low. And hey, George told me he was going to buy. Maybe he's in there buying. I'm going to go along with it because price tells me that I should buy. Your market structure chart implies accumulation is always sandwiched between decline in markup? Can it also sandwich between two declines in markups? Excellent point. So what he's referring to is, going back to this chart, is, that this, we only know if it's accumulation if we break a higher high. And then we say, okay, the buyers are in control. This is likely a stage two. But if we look at it and say, if the stock does this and breaks down from there, we'd say that's a failed breakout. And this is, stocks come down and they correct price-wise, time-wise, and it's not as likely after a time correction that we continue lower, but it happens. So we saw a failed breakout in Upstart. We saw a failed breakout I had a whole list of them. But just in the last month, we've seen a lot of failed breakouts that on a weekly chart looked like they were entering fresh stage two uptrends. Instead, they failed. So only price pays. So if we, turn sideways here and then instead we saw the market break higher like this, well, I would be buying right here and say, we only know, just like support and resistance, we only know that 200-day moving average was resistance once we broke down from it. That's when we know. And we only know that it was distribution if it breaks down. Until then, it's just neutral. But it's neutral after a large rally. And that means it's either digesting the gains and building energy for another push higher, or if it breaks down and the moving averages are curling lower, odds are it's entering a new downtrend. So now I consider this market guilty until proven innocent. And if it rallies back up, I'm going to get stopped out. Then I'm going to look for more constructive action on the shorter term timeframes, and maybe I'm going to start to get long as well. So good question there, Neil. Aaron says, I've always had problems to place the anchor for the VWAP. Well, have you read this book? There are basically three categories. One is price action, meaning highs and lows. So the low, the year-to-date low was made Monday morning. The year-to-date high was made in January on that breakout. The all-time high, I'm talking about the S&P 500, was made on, what day was that? That was the 19th of February. So we put an anchor off the all-time high. Now our new all-time low, year-to-date low, is made on April 6th. So we put them on, price extremes. We put them on events. So if you go back to one of these charts right here, this is the anchor right here. This is the anchor from when the tariffs were announced. This is the anchor, the purple one, is the anchor from the news yesterday, the tariff news